Hi, I'm Anthony Planis. I'm the research analyst for Matt Battielli's Real Wealth Strategist. How do you figure out when to sell a stock? Did you ever hold on to a stock so long that your win turned into a loss? Did you ever let a gut feeling scare you out of a position only to see the stock soar after you sold? Or have you just wondered when you should sell? These are common problems for many investors. However, one simple technique can solve that problem. It's called a trailing stop, and it takes the guesswork out of owning stocks. In this video, I'm going to show you how to use trailing stops. I'll tell you why they are important, how they work, and an easy way for you to use them every day. Let's jump right in. How do trailing stops work? A trailing stop is a simple calculation that tells us when to sell a stock. We decide how much money we are willing to risk, and the stop tells us when we hit that point. The important thing about them is that the stop acts like a ratchet. As the stock price rises, the trailing stop price does too. However, if the price of the stock goes down, the stop price does not. When the stock hits our stop, it triggers the sell, protecting our wealth. For example, if we bought a stock for $5 per share and decided we only want to risk 25% of our position, we would use a 25% stop, which means we would sell if the price closed below $3.75. 100% minus our stop percentage, 25%, is 75%. So we multiply our buy price, $5, by 75% and we get $3.75. Let's say our stock went up from $5 to $10 per share. Our stop price would rise with it to $7.50 per share. As you can see, the stop value rose from $3.75 to $7.50 as the stock price rose. If the stock price closes below our new stop value of $7.50, we know to sell our shares and secure a 50% gain. That's why trailing stops are so important. One stock that we held in the Real Wealth Strategist portfolio is a perfect example of why we use trailing stops. We entered our position in Pretium Resources on July 17, 2017 at a price of $9.62. Using a 30% trailing stop loss, our stop loss would be $6.73. $9.62 multiplied by 0.7 is equal to $6.73. In the time we owned it, share prices saw a high of $12.17 on October 12, 2017. Our stop loss rose with it to $8.52, or 70% of $12.17. That means that if Pretium closed at or below $8.52, we knew to put in a sell order the following day. We only watched closing prices for our trailing stops. As you can see, we sold based on the stop, but Pretium shares continued to fall. It bottomed below $6.60 per share, another 23% lower. If we did not use a trailing stop loss, that would have been a 30% loss on our investment. But because of our stop loss, we knew to sell at a much more manageable 11% loss. Now, I'll answer a few frequently asked questions about trailing stops. First question, can I put my stops in at the market or through my broker? We don't ever want to put our stops in the market because we don't want them to be public. If the order is in the market, it is visible to market makers. And when thousands of people all have roughly the same stop, it becomes a target for manipulation. We've seen this happen. If we put our stops in the market makers can see what our stops are. They can short the stock so that we hit our stops, causing us to sell our shares. Then they can swoop in and buy the share more cheaply, grabbing a quick profit. These stops should be internal, so you won't set a stop with your broker. We track our stops on a spreadsheet. This is part of our homework as investors. If the stock falls below the stop value we're tracking in our spreadsheet, then we sell. Second question, how do I track stops in a spreadsheet? We recommend using Microsoft Excel or Google Sheets for creating a spreadsheet to track your trailing stops. We can use a handy function, a formula to perform a calculation, in Excel to make the math even easier. This is easy to do even if you haven't used Excel much. Let's make a column for our companies, symbol, current price, high price, and trailing stop loss. Under our trailing stop loss column, we enter the equation in column E, row 2, equals D2 times 0.7. So that takes 70% of the value of the high price for Pretium Resources, column D, row 2, which in this case is $8.52. Now, every time you enter a new high price for the stock in column D, row 2, the equation will recalculate your new stop loss. You can follow these steps for each of the stocks you're tracking. Just be sure to change the function to reflect the correct row. D3, D4, D5, etc. And the correct percentage, 75% for a 25% trailing stop, 70% if your trailing stop is 30%, etc. This might seem confusing the first time you set it up, especially if you haven't used Excel much, but with a little practice, it will get easier, and you'll be able to track any position in your portfolio this way. The important thing is, if you stick to your stops, you will protect your cash and let your winners ride. Trailing stops don't predict winning stocks, but they let you maximize your gains and minimize your losses. That's 90% of investing right there. I hope this makes trailing stops a little easier for you to understand and use. They make a huge difference in our portfolio performance. Thanks for watching.